20 months old, and we've been building on the new strategy we set ourselves post the carve out. And it has been an interesting journey. As an organization, we have been able to kind of overcome various variables, known and unknown, post carve-outs, and we are in the process of building a stronger foundation for the company. Because as you're aware, 3i, which was born way back in 1993 from ICICI Bank as a carved-out unit and got listed way back in 2005. Had its highs and lows. It was almost $1 billion company in 2008. It had made various acquisitions of more than 50 to 60 companies at that point of time. We're in the top 5, 6. Then unfortunately lost its track and became a CDR company. And last year in 2021, the product division, the various IPs were sold out and the company became debt free. And that's when me and the new management inherited this company. The uniqueness of this is opportunity, and the challenge in front of us is also basically because 3i was never a services company. It was a product company which also did services. And now we are the residual carved out residual entity was a services company, because obviously the IP and the products and all other valued assets of the company were sold off in a slump sale. Now, building from what was left is where this new organization is building. So we started off a journey in strengthening 2 tracks. One is to be on parity with our services business, with our peers, because that has to be bread and butter. And in parallel, also to quickly invest in non-competing products and platforms in terms of what we have sold off. Obviously, we have a 5-year non-compete of where we cannot develop similar products and platforms. So we wanted to invest in other build initiatives to kind of build new products and platforms which will create IP and more sustainable revenue and valuation for the company. So just to refresh our memories, we just call it the Grow, which is our digital business, which is being on par with our services, and the Build, which is our next gen and future tech business. And there we wanted to focus predominantly in our edge computing services, and we stay focused on that, whether it's edge application, edge analytics, edge security, or anything to do with edge computing is where we are investing our focus to create value for the organization. And we also use some of these prototypes and products built in edge to differentiate our services as well. And from an industry perspective, we have been predominantly a BFSI focused, and to an extent government in the past. Now, post carve-out, we are also building on telecom, media, and entertainment as an industry vertical, not just selling to telcos, also selling through telcos, and selling with telcos is an important strategy. Plus, we are also strengthening our retail and manufacturing verticals as well. So with that, also, if you look at it, the global macroeconomic changes are changing so swiftly and fast that companies have to reinvent and rediscover ourselves. And personally, I feel with this changing environment globally, with a recession very clearly in the Western economies, and especially for us, 50% of our revenues, so 50% and more comes from some of these economies. So it's also a threat, but we also see an opportunity in these economies because of recession. There's a clear-cut, opportunity for tier 2, smaller players who will be able to be more nimble, agile, or able to probably use this challenge to rediscover the business model, redraft it, maybe set your own ground rules. That's a great opportunity for us to build on it. So I'll pause here, and then maybe I'll take questions from you all.
Thank you. So first line, we'll start the Q&A session. First question comes from the line of Pritesh Vora. He's from Mission Holdings. Pritesh, you can unmute yourself and go ahead.
Can you explain a little bit about business sector vertical-wise, what exactly product or services you
Sorry,
provide?
participants, please mute your line. They're not speaking. There is a lot of disturbance in the
market opportunity in the products and services you serve. And also, if you can little bit know about what are the growth drivers in those verticals and how you plan to capitalize on those growth drivers? As well as, can you brief us about what is the tax position latest? Why you're not paying your taxes? Is it some accumulated losses or something like that? So can you give these three questions, please?
Yeah, maybe the easier part, maybe first, Sanjay, you want to highlight on the taxes, and then I'll take into the other strategic drivers and growth. Sanjay, you're on mute.
Yeah, sure, Thompson, and thanks, Isha, for the question. The taxes we see, we have a carry forward losses over the years, which as you are aware that since we have a carry forward losses, the current year, anyway, last year also we had a taxable loss. So that is one of the reasons that we don't have a tax liability as of today, Rishabh.
And this will go on up to what period of time where you remain within the tax bracket?
So we see, say, another 2 to 3 years, 3 years at a go, that we see that this position will remain from a India standalone
So
perspective.
you will not pay even MAT tax, even MAT.
So no, we are not. Yeah, we are not in the MAT purview, the 115 purview.
Okay. So whatever PBT you generate next 2-3 years will remain as PAT.
Correct. Because we have a carry forward tax loss. That is the primary reason.
Okay. And first two questions, please. Thank you.
Yeah, Rishabh, thanks. So coming back to your first question in terms of industry and strategic drivers of growth which we see for 3i. See, one of the things also we have been also trying to narrow down our focus areas also, just to stay focused on few core focuses. So one clear driver which we are building on is our Oracle COE, which we invested and built. So for example, just for your information, we have invested heavily in Oracle COE as a differentiator. In fact, our first batch of 100 engineers are graduating from Tirunelveli. It's a tier 3 experiment which we did. In fact, it's been very successful. Even Oracle is surprised because most of our engineers have come out with higher scores in faster time, and they are all becoming billable ready right now. So one strategy is to work along with Oracle globally, especially in their legacy area, because Oracle has got a huge legacy space where we want to work on migration of their legacy businesses to cloud. So that is a very, very clear area we are super focused on, and we want to emerge as a preferred tier 2 partner globally. That is one clear action item even for our next financial year. That's our strategy number one, where we will measure very clear-cut growth, because it's a big opportunity because Oracle sits on a huge legacy base. That's strategy number one. Strategy number two.
Before we come to the growth drivers, if you can let us know the what exactly business vertical wise you do, because I followed your company some 10-12 years back, and there were many divisions, many product and services, many geographies. So if you can let us know top 3 or 4 revenue drivers within your company, which are those product and services, what exactly do, and then we come to the growth drivers. That will be much easier to understand.
Yeah, sorry. Yeah, so just for your information, because see, once we sold off, since you've been following the company for 12 years, the first start point is that most of the products which the company hold has been sold off. So as of now, we don't hold any new products, old products which we had built over last 15 years or whatever it is. All that has been sold off, and that's how the company has been debt free, just to reset understanding. So whatever new products and platforms we are building are new ones which we are building. Definitely, as I said, we are building in the edge computing space. One of the products we have released, and it is very successful, it is also growing very fast, is NewRay Edge, which is a SASE product. Just as an example, NewRay is our new brand. New and Ray are both cloud, which means cloud first. So what we want to do is everything is cloud first. So that is one of the new lines of businesses which we are building. That's point number one. Now, from an industry vertical perspective, we had the residual businesses in BFSI and government, and to an extent in retail. So from within that, now within that, our existing lines of business has been, because of our banking pedigree and we had domain knowledge in BFSI, we naturally come as a line of businesses, application management services for products and platforms for banks. testing services, which comes naturally for, let's say, for example, it could be for FlexCube, it could be for any banking products we have, or testing COC, which are developed around it. Similarly for insurance also, if you look at Life Asia. So these are natural strengths which we have, which is application management services, testing services, which are our bread and butter services, which is there. We also have a huge footprint on infrastructure management business. If you look at it, we manage our infrastructure management business pretty sizable, whether it is data center operations or end desktops management or field management, or the entire stuff is a very huge sizable business. Even recently, we won a very large business from HPCL, which is pretty sizable, a 3-year contract for 40 crores, which is to manage their entire data centers, their desktops and end user support. It's a very massive order. So these are some, and we also have a BPO business, which has the typical back office of the banking process, which is typically which we call our run or a classic business, which pays our bills, Rishabh. So this is where we are. Now, the new lines of businesses which we are launching and we are now making is cloud business. Cloud is a very important area where we are investing. We have had some wins and we are changing the mix of business. Entire thing in cloud, whether it's cloud in a box, cloud transformation, or cloud optimization. And one very unique service which we are differentiating ourselves from peers is multi-cloud management, in terms of, because we have some secret sauces by our tie-up with some technology partners and startups and entrepreneurs, which has been our way to kind of accelerate and compete with peers. So multi-cloud cost optimization is a very, very important driver by which we are now gaining momentum. We've also launched our New 3i, which is our cloud for on Amazon bare metal. So fundamentally, what we are saying is on similar Amazon spends which you might have, we'll be able to save almost 20-25% of that. We have already got 2-3 contracts in that when we are now scaling up that line of business as well. And New 3i Plus is an Oracle cloud. We launched it in Malaysia. It is picking up and we are selling it as disaster recovery as a service even for enterprises. So this is the other line of business where we are. These are sustainable revenues which we will generate over a period of time, because once you get into a contract, you get into 3 years and then you get that. And then you also have projects where you could migrate and or converge the spends of CSP, which is a cloud service provider, or an MSP. Because of huge cost pressures, there's huge opportunities to optimize cloud spends, and cloud is going to be a kind of recession-proof industry as well. So that's a very important line where we are investing, and we are successful also. Want to stay focused on cloud first, data center transformations, helping companies to do that. And I spoke about the Oracle COE, which is also a very powerful line where we want to stay focused. And the new products also gives us huge opportunities to get into the cybersecurity space, especially Nure Edge SASE product gets into cybersecurity. We are able to also give offerings where we can cannibalize the existing models of cybersecurity operations. We have had some initial success in that as well. And then we are also building the new age products like 5G Lab as a service in our IIT Tech Park. These could be definitely game-changing products where our revenue models can change dramatically from the traditional services models.
Sir, can you bifurcate, like what I understood from this conversation is that you have a SaaS product in cybersecurity, then you have traditional product ADM and testing ADM business as well as testing business. Then you have a sizable business in data center infrastructure management.
Yeah.
And then you are going into the cloud business for Amazon and Oracle Cloud. You are entering it. Can you bifurcate these 5-6 businesses? What is the revenue at present, and how do you see which vertical is going to grow what rate?
A great question. So if you look at it, the classic business, which is your typical, what you said, like ADMS, testing, IMS, whatever, what we inherited and what we are building on, still continues to be almost 80% of our revenues today. It has changed from where we started. When we started, we were only around 95% there and 5% and we had. Now we have moved to maybe around 80-20, where the other lines of businesses which we started investing are starting to bear fruit and we have revenues coming out of it. For example, Cloud First is generating more revenues for us independently as a brand. The Oracle COE is generating a business. In fact, we won a very large, relatively large, not very large. I don't know whether the news has come out. I don't know, but we've signed a contract with a top Indian company for the Oracle COE for almost 18 crores. So these are the new lines of book, and the order book is changing. To your question, so what next year's financials, the way we look at it, we want to look at it almost like 70-30 revenue mix change, where 70 will be the classic lines of businesses and 30% will be from the new lines of businesses. Plus, also we want to get into the SaaS models in some of these products also. We are running 2-3 pilots with telcos where we are selling it to telcos customers. That is, for example, we offer this as a white label to a telco. Telco offers the SaaS product to their customers. And if these prototypes and pilots are successful, this could be different revenue stream altogether, because each telco's got almost 500, 600 customers, SMBs, and each of them will have different requirements. And so this is going to be a kind of a snowballing effect, if I can look at it. And we hope that these projects will be successful, and our SaaS products will be able to generate a lot of revenues. Plus, also on the same line, we are also launching our SD-WAN. SD-WAN and private networks is a big opportunity because if you remember last year, we invested in a Silicon Valley company called XCM to get access to the technology very early. And that technology is very, very helpful for us in building all these new IPs for us, especially 5G Lab. We are building on top of it, which will be a new product platform for the company. The SD-WAN is built on top of it, and the private networks we are building on top of it. So these could be great alternates to large players like Cisco or Fortinet, even in SD-WAN. And a lot of CIOs and CTOs are now considering us very seriously. Pilots are there because this could be potentially 50% of a typical Fortinet cost. But we still make another 40% gross margins on top of it. So these are the new lines of products and where we are investing, and which will give us more revenues next financial year.
So how do we construct the growth in the business, traditional and the new age business, and what kind of, because margin profile over last 16 quarters, it was very volatile kind of thing. So how do we think about margin in those businesses?
No, absolutely. Now, if you look at the math, if you look at it, when we inherited, it was almost 90-95% was classic business, and the margins were very less, with hardly around gross margin of 14%. Second thing also, since we were not a traditional services company, we didn't have the offshoring business. So at least if you have the offshore business, your margins will be higher. You compare with any peers, because that's a bigger problem I have explaining this to everybody, because since we are not a services company, any small company will have a huge offshore base, and we missed that. I would say we missed that opportunity, or missed the bus, because we had only an onshore business, which is traditionally onshore, and so your margins are less on the classic business, which is not greater than 14-15% gross margin. It's very difficult. And in parallel, we have to make all these investments for the new lines of businesses, also from the same cash. To your question, all the new lines of businesses, which we are now starting, are all minimum 30% gross margin, 25%, and some of the products I spoke about can get us even 40-50% gross margin mix. So there are kind of 3 tracks. One track is your typical classic business, which is around 15% gross margin because it's predominantly onshore. How much you optimize, use technology, highly competitive, which is around 15%. The other digital businesses, which we are talking about, which is your cloud, will get you around 25-30, even if you do onshore with a little bit of lesser. The moment we increase more offshore or automation, that will go up, so 25-30. The other next-gen businesses, which we are now starting, will definitely get us, even with deep discounting, we will give 40%-50% gross margin. So if you ask me a simple business plan, keep doing the classic business because it pays our bills. Try and see how we can run it more efficiently with more automation, get the GM up from say 14, 15, 20, 18. So that is strategy number 1. 2, get almost 20% of our new revenue should come from the new line of businesses, which is around 25-30%. And stay focused on the third line, which will take time for the new products and platforms, and it's got its own cycle to get 40-50%, but also huge volumes on that. So broadly, these are the 3 lines in which we will be going forward.
Can you talk about the operating margins? The gross margin, we got the idea. How does it look operating level? Because 80% of your business is classical businesses. Gross margin is just 14%. How we are thinking of operating margin there? And what is our growth? How do you view the growth in each line of business? And what is our operating margin target?
See, the operating margin target is very simple. Even in the last quarterly call, I spoke. The first target for us is to break even in this current model, constraint model, because the 75% classic business literally fuels the balance businesses, because we don't have any other cash or any other investments by which we have to do it. We have to fund it from the same P&L. That is what we are doing. So it's extremely difficult. If I stand alone, if I look at let's say, for example, I spin off the business into three. On a operating margin level, the run classical business will be around 4 to 5% EBITDA on its own. But that 4 to 5% EBITDA is now funding the grow and the build also, so which we need to take care. So now what we are saying is, at least the team is working hard is, can we be operating margin positive with the both classic and the new business together with all the investments? This is what we are now driving, and that is what we had also promised all you guys as well. So that is our first milestone, because we have to be profitable in that operating model.
Thank you, sir. I will come back in the queue if required.
Okay, thank you.
Thank you, Pritesh. Next question comes from the line of Rishabh Ghia. Rishabh, please go ahead.
Sure. Can you hear me?
Yeah.
Yeah. Hi, Rishabh.
Hi. Hello, Mr. Thompson. Thanks for the opportunity. See, the company is in a repair phase. That is how I'll take it. I've not tracked the company way too long, so just calling that out. But it seems to me it's in a repair phase. And Mr. Thompson, it seems it's all over the place that you guys are trying. I mean, you're trying to become a Tatacom in SD-WAN and maybe a Mastech in cloud Oracle implementations. And then, you have a PSU business, which is low margin, and then you're in infrastructure. And then the list goes on. Don't we want to focus on... Can you hear me? Hello? Hello?
Yeah, Rishabh, there was some disturbance, but now it is fine. Maybe we can off the video so that I think net connection is poor, I guess. Thompson, your line is also freezed. Maybe if you can just we do a voice call, that should be better. Thompson, we are not able to hear you.
Yeah, I don't know, some network issue. You can hear me now?
Yes. Yeah. So, sir, don't we want to focus on a couple of business problems and try to get that right instead of, having multiple bets taken at this critical stage of, the repair?
No, maybe I missed a little bit on the middle part of your, if you can repeat, if you don't mind, because I had a poor connection, if you don't mind, Rishabh.
Sure.
I did, the opening comments I heard about the repair phase and the focus areas, but maybe if you want to expand a little bit, that'll be good. I missed it.
Yes. I think, when I heard the narration on, things you're betting on, to me, it appears that you guys are in a repair phase, but trying too many things to, to solve. Isn't there a better way to approach it where you focus on a couple of business problems, whether on the services side, on the platform side, product side, and get that right and create a profitable core before, branching out on these various business initiatives? That's my first question. And maybe after that, I just like to understand a little bit on the current.
No, absolutely, Rishabh, absolutely. You're spot on. I'll just maybe I'll try and answer that. That's why if you see my opening comments, we did set out multiple boards, but we are reviewing them very, very clearly and now this, even if you start Jan 1st as a new year, we are very, very focused that we only want to invest our time, energy in a few initiatives, get them done. So that clarity is there. That's why I said, see, we want to stay focused on the Oracle COE, work closely with Oracle. It's a clear strategy, and we are seeing bidirectional support. That is one. And even within that, we are super focused on OCI. We are focused on data lake. I'm just saying, see, Oracle is a massive ocean by itself. So we have super specialization. We want to be there. So we want to be like a boutique recall player number one. So that is one. We are very clear on that. Second, if you look at it, there's a big opportunity. If you look at it, even in the Western world, if you look at it in the mid-market, to help companies extract their assets better, or asset utilization. So assets could be infrastructure. It is like my data center, my cloud, or my application. So we want to stay focused on that. We're building a clear-cut consulting capability where you can consult and implement in these areas. So that is in the cloud first plus data center. So we are very focused on those two areas, if you may do, and we will lead with this into various organizations. The third area which we have invested is in the cognitive computing. And also I want to tell you, Rishabh, we have a very unique model, I'll tell you. What we have done is we have invited resident entrepreneurs. The entire build area, we have brought in resident entrepreneurs, given them the opportunity to create products and platforms for us. It's a very, very frugal model. Very few companies do that because, since we have all worked on the other side, we have seen how large companies squander these entrepreneurship programs. We have created these programs. It's a very, very frugal model, allow entrepreneurs to come in, build platforms, products. We leverage all the common assets, but give them the freedom to do that. You won't believe it. Some of them are now already valued. They're all valuation ready. And we keep them under a separate umbrella for that as well. So some of the initiative, which I said doesn't happen part of the regular services organization. Say, for example, the entire IT tech park, where we have housed these resident entrepreneurs functions differently. It's like a separate company with whatever, we are like the seed capital investors. Now each of them are growing up, and we could also get investors in each of these subsidiaries. In fact, we registered some of the subsidiaries right now. They're all in that level where they have unique value for their products. So independently, they'll create value. The mother 3i can leverage them, use them for services, but they will also grow. Just to clarify that also. So we are very super focused on those as well. So that we don't get distracted in that as well. And they are self-motivated entrepreneurs with very minimal governance who will be able to drive results for us. That is, but absolutely to your point is we also want to be very, very focused. If you were probably we started 10 initiatives, we want to stay focused on 4 or 5 very, very clearly. And you rightly put it, it's a repair phase. And we are repairing this aeroplane as we are flying across Atlantic, and we cannot land it, and you're spot on. So we need to keep running our existing classic business, which pays our bills, run it more frugally, and also deliver operating margin profits along with the new business lines we have launched it, and get our own, unique value proposition or differentiation in the market space, because we are in a catch-up mode, even as a services company, assuming you just keep the products and platforms separately for a moment. So as a services company, we have to really differentiate ourselves. So we have to be more aggressive from a challenger perspective, and a higher quality at a lower cost is the way forward.
Okay. So if I can summarize the top 3 bets, one would be you'll become Oracle's system integrator, right? So basically, yeah. Oracle would have supply chain, retail, ERPs.
Absolutely.
You would go find customers and implement these for the customers.
Even Oracle will find customers for us, Rishabh. They will find. Sure. I will just have to implement. You know what I'm saying? That's it.
Okay. But this is a global business, I hope, right? You aren't.
It's global. It's a global.
Indian geography, correct?
Yeah, it's global.
And do you have the Salesforce bandwidth and all to, break into the, Western worlds, Americas and all?
Yeah, so Salesforce is another, as you rightly said, for us, it's a tough call, because sales cost is huge. We need to manage it. And one of the changes we are doing right now is to optimize sales cost, because we have built our practice, pre-sales and support costs so far. In the sense we have probably strong. And one of the close look we are looking at it is in optimizing our sales cost. In fact, we are setting up a channel network and sales franchisees because see, again, necessity is the mother of invention, which is more better. So we are setting up that network of channel partners and sales franchisees to reduce our cost. Obviously, we have invested in the practice and pre-sales cost. And in fact, right now, my trips in US and UK have been to establish this network for us for the next financial year so that we reduce our direct sales cost because that will be prohibitory for us and we can't afford it. We have minimum presence in all the geographies. So we'll have 2 tracks running, or in fact, 3 tracks. One track is a direct sales where we have our existing accounts, you mine our accounts, manage it and go for some new logos. But the new logo hunting will be predominantly channel-led, sales franchisee-led. And the third is alliances, where we work with Oracle Salesforce very closely. So that's a 3 go-to-market motions if I look at it. And we have to optimize costs. So we're reducing the direct cost and strengthening the channel.
Yeah, before I go to the next set of questions, at least the feeling that I get is, it would be a difficult problem to solve. There are established players who provide Oracle, system integration services and likewise infrastructure management. But keeping that aside, I mean, I'm a little fuzzy on our right to win in these areas and go build a sales organization and break into US geographies. It's a difficult problem. I'm going to leave it there. But currently, with the you guys do about 700 crores revenue. Am I right with that number?
Yeah, you're right.
And 80% of that you mentioned is your traditional application development testing services.
Yeah, it's across 3: application testing, infrastructure management, all your classic businesses, BPO, all the lines are there.
Okay. Mr. Thompson, so how much of this is exports and how much is India based?
That's why I said mostly if you look at it, 90% of the business is all domestic, which is America to America, Middle East to Middle East, because that's how the company was dimensioned. The exports are very less.
Oh, so when you say Americas to Americas, we have centers there, we have workforce there.
Yeah.
On site.
Yeah, it's all on site. I got 250 employees who are on site.
Oh, so then doesn't that provide a lucrative action item to create offshore centers and improve margins?
No, of course, see, Rishabh, theoretically, we've all done that. I've moved personally, if you ask me, I've moved 10,000 jobs to India in my career. Okay. But, the point is today, I think we have missed the bus for 3i. If you ask me, like you walk in, as you rightly said, and you say that I'm going to move jobs to India, nobody's going to give the jobs. Now, what people are interested right now for a challenger like us is, can you do, onshore, nearshore with, what do I say? Same budgets, or can you disrupt a Bangalore delivery center and do it for me in near shore or onshore is what people are interested today. In fact, we won a deal right now, 40-member team working for a tier 1 provider. With our platform and technology, we are doing to 10 people onshore and give the customer 25% discount. So that is where the market is moving. So today, if you ask me, you're absolutely right. There are entrenched players who have working India-centric model, which will not work for us today because we are very, very late in the game. You're spot on. What will work for us is a country-specific model where you have high on digital, high on automation, and we don't have the margin pressures what my tier 1 peers have. Simple example, all my tier 1 peers have a minimum EBITDA margin of 27, 28%. I'm saying if I even give you 6-7% consistently, all my investors are going to be very happy because that's where we are today. So I think there's a big opportunity to build an onshore business, which is the biggest opportunity because we have 250 people in US, we have around 100 in Middle East, we have 100 in Thailand. So that's an opportunity. I look at it as an opportunity. And to your point of
Maybe I didn't understand this fully. So see, these are our long-standing customers, right? I mean, you must be having deep relations with them. And even if your delivery center is in, say, US or Thailand or Europe, can't you have that conversation with the customers that, look, we'll move the contract remains with us, but we get it delivered out of India at half the cost.
Right now, Rishabh, I've been seeing what even US and where we are. I'll tell you the typical mid-market space, right? I'll give a small example in banking in US. Okay, where we are focused is the mid-market, more like credit unions or wherever it is. I cannot go find a war in a tier 1 large bank because it's very difficult. So the mid-market is where we are, like financial services, like a payday loan kind of customers. These are our customers, right? Now, most of them, if you look at it, though we do have offshore components, but today there are headwinds there for them to do the jobs in US because every country is getting kind of this, very focused about their sovereign thing and the job should not go. So there's a lot of resistance to that. So what is happening today is, in fact, we are working on a deal which traditionally will be done with, let's say, for example, 100 people offshore. Can we do it in 50 people onshore with the same budget? And, can we manage profits out of it? Because that's where it is going. So can we have more technology, fewer number of people onshore or nearshore, at the max Canada or Mexico for US and do the business? So that's the trend right now, Rishabh.
Yeah, I won't take too long harping on this, but sir, that came as a surprise. I mean, I do track a fair number of IT services companies. I mean, especially in the ARD space, the offshore component has gone through the sky. So,
No, that's why I said, Rishabh,
it comes as a surprise that the customers are resisting, offshore delivery. Because otherwise, you guys are sitting on fair bit of contracts, right? It can be moved offshore, and that becomes the first profit pool to tap into.
Absolutely. No two ways about it. I'm not saying no to that. Even right now we are having offshore components for our US customers. I'm just trying to explain basically because this company was never built as a services company. It was a product company where product support was sold along with it. So the model was different. That's what I'm trying to tell you. Now in the last 1 year, you want to change it overnight, it may not be possible, right? That's the point I'm trying to say.
Sure. I get it, but sir, wouldn't that be your first problem?
Of course. No, of course,
if we can frame the question, because let's assume that of this 80% or 700 crores of top line, even if you shift 500 crores, I don't know. I've not studied the company. I'll probably come and meet you one of the days. But with this 500 crores, you move offshore and you automatically become profitable in a way which becomes a core to feed future goals. But this seems to be the low hanging fruit rather than going and establishing a platform or a product line.
No, absolutely. See, that's in my mind, in services a no-brainer. We are trying for that. So I'll give you a small example. I told you some of the graduates in Tirunelveli, a tier 3 city, already 25 people are now ready for offshore. Okay, so they are now doing a shadowing. If we are successful, we might start billing them from offshore for our US customers. So of course we will do that. But all I'm saying is the type of headwinds which are there for offshoring. Of course, that's a number one priority, right? It's a known tested lever, right, Rishabh?
Sure. Okay. Just a few questions on balance sheet, and then I'll get back into the queue. Would it be possible to quantify how much of this 800 crores or 700 crores top line is annuity? And maybe this question is for Sanjay, the CFO. That what would be the cash flow from operations based on your estimates, Sanjay?
Yeah, I'll take that one, Thompson. So right now, going forward, I would say annuity business we have in the range of, I would say near to our 60 to 70% of, like Thompson was saying, the existing business that we have from run operations is about 70%. That's our, 600 crores, I would say, is our annuity business. And our cash flows are pretty tight right now, since we are also investing in the build business where we are building for future capability. So what I would say is going forward, we would be in a positive cash flow situation. But right now we are in a tough situation for this quarter and going forward for the next quarter.
Okay, and zero long-term borrowings, correct?
Yes, you're right. You're right. Zero long-term
No
borrowing.
long.
Yeah.
Thank you much. Thanks. I'll get back in the queue.
Thank you, Rishabh. Next question we'll take from the line of Siddharth Gupta. Siddharth, please go ahead.
Hi Thompson, hi Sanjay. Thank you for this call. I just have a couple of questions which are actually building up on the previous questions. I think there was a question about the taxation. You said that there are carry forward losses on the India standalone business. So just to clarify, this is not for the consolidated business. On the consolidated front, we would end up facing a taxation burden. And secondly, could this quantum of losses could you tell us what the quantum of these losses are, to the extent that how much are we expecting? I mean, you say it's 2 to 3 years, but a quantum would be nice to have an exact figure on this. The second question is for Thompson. Thompson, I think in the previous question you mentioned there were headwinds against offshoring, and I completely agree with what Rishabh had mentioned in terms of shifting goals from selling the product to actually just ensuring the America to America business is shifted to an India to America business or India to Middle East business. So what are these headwinds that you're mentioning? Because most other IT companies are predominantly pushing towards this front. I'll ask these two first, and then we can have.
Okay. So I'll take the first one, Thompson. Then maybe.
Yeah, go ahead, sir.
Okay. So our effective tax rate, to the point that you have raised, is actually negligible, because whatever profits that we have is in the US operations, and that's minuscule, to the overall consolidated. So I would say our effective tax rate to the consolidated revenue today, I would say it's very bare minimum. Okay, just to get the point. Second, we have our carry forward losses to the extent of about 150 crores, which is on, I would say, not on a long-term capital gain, but on the current tax. So about 150 crores is what we're talking about, is our overall tax. I think that's what you needed, right? Anything?
Right. Yes.
Yeah. Thanks.
Okay. So I'll take the next question which you spoke about. There are two parts to your question. One is, if you talk about, the other gentleman spoke about the offshoring, because it's a no-brainer for any services company. But for us, it is very, very minimal right now. The percentage mix, if you look at, will be hardly 10% or 15% of our workforce is on the offshoring model, and that's the biggest issue. And I agree with what Rishabh spoke, and we are trying to see how we can change the mix, at least in existing customers or wherever we can do that. But for some of the other customers where we don't have big, larger relationships, smaller relationships, where we want to go and expand, what we are seeing is very clearly there are headwinds because of the economy is not growing right now. There's a lot of job losses everywhere. There's a lot of resistance for offshoring. So what is well received, if you look at it today, is onshore with heavy digital and technology, where we are able to put skin in the game in terms of performance related, contracts. So you have a fixed contract, which is no different from a domestic model, which you might not get more than 15% gross margin. Okay. And plus you can earn the upside by variables in terms of KPIs. KPIs could be different functions which you are now delivering. So if you are in customer service, we're just negotiating a contract for customer service heavily on technology, bots, you name everything. What traditionally 100 people will do, maybe you can do with 40 people, but fixed will cover only our gross margin will be like a typical domestic business, right? You will not get more than GM 15%. But let's say, for example, if you increase the CVM, I'm just saying it's an example, customer value management, you increase their upsell, cross-sell. I'm just giving an example, okay? You'll be able to earn another 15%. So it's linked to variables. But it's all onshore because they cannot take it offshore. I'm just saying the mid-segment banks or whatever it is, they don't want to have, those are not the typical ones, even the tier ones are focusing on, because they are all happy with their own large customers. Now they are coming into these accounts, if you ask me, mid-market ones, where we are focusing. So that is where we are now trying to capitalize this trend, where they are looking for companies who are focused on automation, digitization, and insights-driven services, which are not necessarily banking on just putting cheaper bodies in India. And the second thing also, so India also, if you look at it, we have a huge constraint on talent. It's not so easy. Most of the top cities are all gone. Even if you have to do offshoring, we have to find other cities to build offshoring, because it's pointless doing it in Bangalore, Chennai, Mumbai, Delhi, and the normal suspects, Pune. It's all overheated. It's unviable, I could say, if you ask me.
Okay. So now, Thompson, just a bit more on the end of. So at the beginning of the year, you guided for a 760 crore revenue and a 15 crore EBITDA, as you termed it as a blood commit promise. So are we still on track to achieve that, given what our first H1 performance has been? And if not, what are largely our revised guidance in that particular sense?
So Siddharth, if you remember, sorry. See, even we were pretty young that time also, hardly 3 quarters, 2 quarters went off in this, but still we want to set a goal for ourselves. So we set that blood commit goal so that the entire company can rally around it. So we set it and we are running towards that. Okay. From the 760 crores and 15 crores, and we are running towards that. Even right now, I don't want to give up on this. Okay. We want to stay focused on that because it's very important, because it unites the company and goals unite the company, and we will work towards that, to your point. Right now, if you ask me realistically where you are, if you're asking me to try and do that right now, I potentially do not want to do that right now. We want to stay focused on that 760 crores. At least we want to hit the top line for sure. Okay. Because bottom line, obviously, we have other variables keeps on hitting us. It's not like it's a clean. I told you, right? It's not like a clean startup. Something from the blue will keep on hitting us from the past. And it kind of probably takes us by surprise. But anyway, but the core, what we want to stay focused is making this a profitable operating model. I think that's the focus, if you ask me. I think the previous gentleman asked the right questions. If you ask me from the mix perspective, how will we stay focused? What we need to cut? What are the kind of priorities? And ensure that we can fund whatever we could do for the grow and build from our run P&L. So run plus grow has to be profitable, actually, because that's the only way we could do it without creating more liabilities and trying to manage with what we have right now. So that's what we are doing, Siddharth. So a simple answer to your question, we at least want to have quarter-on-quarter profitable operating models. That's the first milestone, if you ask me. If we have done that, and with our top lines growing, we will be able to hit all those numbers automatically in the coming quarters.
Thompson, I just have a couple of more questions before I jump into the queue again.
Just one point, Siddharth, one point I'll leave it with you. And what is happening also for us is we have got a lot of new logos, new contracts. We have also been systematically purging some old ones also, which are not profitable. So what happens is that our growth is net of all that. That's a purging of that. And second, some of the professional services, obviously, the easiest one gets hits is the professional services contracts, because they're not sticky contracts. They're just, especially in the US or whatever. And we are growing net of that. So if you look at it, we are adding a lot of new logos, a lot of that. And there is a lot of purging and cleaning of contracts also happening in parallel. Just thought I'll leave that.
Right. No, that's actually something I was going to ask as well. So thank you for that. So just quick 2-3 short questions before I go back to the queue. Firstly, there was an exchange filing with regard to a subsidiary being incorporated for certain 5G operations. If you could elaborate on that. Second, is there you mentioned that something from the past keeps popping up and hitting us. So is there something new that has popped up that is pulling us down, or is it just some of the old legacy issues which are already disclosed? And third, you spoke about how the revenue mix currently is 80-20, right, in terms of older business to the newer business. Could you just tell us where we started off in the past three to 4 quarters, how much has it evolved? Because you mentioned that the revenue growth has been net off, and that is clearly evident in the past 5 quarters, where we have largely been reporting in that 170 crore ballpark revenue figure. So could you just take me through the mix change in these 4-5 quarters? How much has it been?
Yeah. So first question is on the subsidiary question. As I said, see, we have brought in a lot of these resident entrepreneurs and we have been investing in them for the last 1 year. Now what we have done is we are setting up these new subsidiaries, okay, which are independent subsidiaries, which are very focused on these products and platforms these entrepreneurs are building. And we are now setting 4 subsidiaries. One is on cognitive computing and 5G operations, Nure campus, and cybersecurity. So these 4 are where we are building IP. That okay, these platforms will create IP and valuation. Independently, these subsidiaries will have their own fair value valuations done, and we could also look at potential investors at that subsidiaries also. That's our strategy. So that will also help us not be dependent on the cash of the run and the grow operations. And most of these build guys can be on their own. So that's the strategy. So we have been like a seed investor. Whatever we could, we invested. We have brought it to a level. Now we will dilute in those subsidiaries and bring fresh capital so that the future capex requirements will not be a burden on the mother company. That is strategy number 1. Okay, just to clarify on these listings which you had. Okay.
Right.
Yeah, so that we can capture valuation at that level and monetize it also, which is good for the parent as well. Okay, so that's the first question you had. The second question which you spoke about is the revenue mix change. See, if you look at it, when we took over, it was 100% was classic business only. When we took over, was almost 100% was classic business. That's what the residual services business which we had, we kept on doing it.
Right. I understand that. I was just trying to gauge the pace of our change, right? I mean, has it been very granular? Has it been lumpy? How has it been moving?
No, I won't say pace of change has been. See, look at it this way. At least 6 to 9 months goes basically to even build basic competence and capability and even convince customers to have conversations with you at a serious level. It's not so easy to build new lines and go to them and convince them on that. And changing the perception of your brand itself is a huge task. Look at it this way. Today, even after so many calls, a lot of investors are not even clear about 3i because are you a product company or platform company? What do you wear? So it takes a huge amount of brand rebuilding itself, if you ask me. So that's what we have systematically been building a brand around Nure, which is the new age 3i, all the new lines, new services we have been building there. And that is your revenue mix. We are now measuring the Nure revenue mixes. Whatever services also we are now trying to measure in that. Okay. So to your point, if you ask me, we have moved to a level where we are around 20% today as we speak. All the new lines which we started are starting to give us revenues in these ones, and which we will have our AOP for next financial year. And like the other gentleman asked me, definitely we want to at least have a must-do number of around 70-30 revenue change, if you ask me. Because as I said, a lot of old contracts also has been purged out, say low margin contracts, loss making contracts, all those useless stuff we have been purging out also. And we have to keep filling up to keep the top line intact. So if you see what we have done is we have purged almost 10-15%, I'm telling you, so many large contracts which were negative or unviable, we don't know why the heck it was, running along with it. So maybe whatever the reasons the previous month, so we have removed all that. So that systematic cleaning is happening. Ask me.
So the 70-30 goals for next financial year, is it? The 70-30 goal is for the next financial year?
Yes, that's right. In fact, our Q4, now we are having a workshop. We are planning for the 70-30 mix in our AOPs also in terms of the new lines of businesses.
Okay.
Because that's the only way we could have a more sustainable operating model, with this lean our cash in hand and how do we manage investments versus these new lines, always impossible. And somebody asked me the question also, if I do standalone only the run business, you will be profitable. But then how long will this company survive? It will be a question mark because unless we invest in these new lines of businesses and keep doing that, the future of the company will be at stake.
Right. Understood. And just a question about any past, you said things keep emerging from the past that keep hitting you. Anything new that's come to light or anything that's
thank God, as of now, nothing. So it's all so far so good, at least where we left last quarter. So no surprises, I guess. Yeah.
Okay. Thank you. I'll just go back to the queue.
Yeah. Thanks, Siddharth.
Thank you, Siddharth. Next question comes from the line of Kiran Cheda. Kiran, please go ahead.
Sir, we have revenues of about 700 crores, less than that. and our equity is around 168 crores. This equity seems to be too large for this kind of revenue. And I know that we have already done the equity restructuring in the past and we have substantially brought it down. But is there anything more, more restructuring in the offing, maybe to reduce the equity more, furthermore?
See, as of now, Kiran, we are all focused on getting this operating model right. See, there are too many changes, right? We had a carve out, then we had this capital reduction, which happened along with that. So now our focus is the next 2 quarters, just stay focused on execution, get our models right. And then, maybe you'll have to look at, thinking from the other perspectives. As of now, no focus on those areas.
All right. Thank you.
Okay.
Thank you, Kiran. Requesting participants if any follow-up questions you all have. Otherwise, we'll conclude this meeting.
Yeah, maybe just one quick one. Who is the promoter for the company now? Do we have an established promoter?
We don't have a promoter, Rishabh.
So it's just a professionally done.
Yeah, it's just a professionally managed company. We don't have a promoter. And so that puts a lot of pressure on us as well as a management team. We don't have a promoter, simple answer.
Thanks. Thank you, Mr. Thompson. Thanks.
Yeah, thank you.
Thank you, Rishabh. Pritesh, you have follow-up question?
So, sir, how do we, I mean, what are we concluding? I mean, how do we see the business and numbers projecting maybe 3 year or 5 year down the line? How do we see this company? I understand we had a long discussion about your strategy and other thing, but what is the key takeaway an investor should go away with this meeting?
See, the key takeaway is, Pritesh, one is definitely we would want to build 2 tracks of revenues, if you ask me. I'm talking all organic. The organic, our first milestone, which we had committed is 1,000 crores, 100 crores. And we want to accomplish that at least in 2 years from now. That's very, very clear. That's our first milestone as a management team. In fact, when I took over, I had committed in my opening because obviously we didn't know the current whatever baggages. If you discount me for 6 months for that, that's what I'd committed. So 1,000 crores, 100 crores is a first milestone which we will deliver as an organization. The second milestone is a lot of these new products and platforms which we are building, and they are B2B2B and B2B2C, which will definitely build the next 1,000 crores for us. Because, so to your point, in the next 2 to 4 years runway, without any acquisitions, we will definitely look at a 2,000 crores kind of a model and try and see how we can change the revenue mix tremendously on par with peers. It will be our focus area. Sorry, you're on mute.
You were saying 2,000 crore, maybe 4 year down the line and maybe 10% margin, something like that, 200 crore of EBITDA.
That's right. That's right. That's right.
And if you want to break, say, 1,000 crore your top line in 2 years, what will be the constituent of those 1,000 crore if we don't go to 2,000 crore level? 1,000 crore.
1,000 crores. I think if you see the last 1 hour conversation is a good start point on that, right? If you look at it, that 1,000 crores cannot have more than 40 to 50% of the classic business, which is now. So the 50% will come from the new lines of businesses, the digital business or the next generation business, which you're talking about. The digital business will be around 30% gross margin, which I would say 40% will be a digital business, which will be the 30 to 35% gross margin. Your classic business will be another 40% to 45. and 10% will be the next generation business, which will be really 50% above gross margins. So that's the revenue mix change we are looking at, and that will ultimately deliver our 100 crores. Sorry? You're on mute.
Ritesh, you are in mute.
Sure. 50% of their business, which is a traditional business, if it continues 4 to 5% margin, we are looking at just 25 crore. So remaining 50% business should bring it 75 crore of margin. So how do you do that? I mean, what kind of EBITDA margin your remaining business should achieve it?
Yeah, so if you look at it, the EBITDA margin should be minimum, 10 to 12%, even the digital businesses, and upward of 15 to 18 for the next generation businesses.
You mean to say traditional business will be 8 to 10%, you said, not 4 to 5%?
No. The traditional what we are doing right now is only around, if I said standalone, if I look at it, will be around 3 to 4% EBITDA, because the GM is only around 15% GM. Okay.
So if
now,
3 to 4% EBITDA of 500 crore, 4% means 20 crore EBITDA, right?
That's right.
So how you are getting 80%, 80 crore remaining EBITDA from new age business? That math, how do you see that math?
So see, for example, as I said, it's around 40 to 45 is where should be the target for the classic business. The balance 40 to 45% should be the digital business, where your EBITDA will be around 10%. So if you look at
EBITDA will be how much for that business? The new
10%.
business?
10 to 12%. 10 to 12%.
10 to 12%. So remaining 50% business, even if I consider 12% EBITDA, 10% EBITDA, say 500 crore into 10, 50 crore, 50 plus 20. So you're reaching 70 crore and not reaching 100 crore of margin.
Yeah. So the other one is where our margins will be very high, which is 25% EBITDA and above, because our gross margin is 50, which is the last 10 to 15%, which we have to do that, which is on our products and platforms. Because we're also investing a lot of products. It's not just services. So the products, our margins will be very high. So like a SaaS product and all, if I sell at $10, my cost price is $2 or $3.
And do you require to achieve this 100 crore EBITDA target? Do you require any capital infusion in the company or?
No, we would require. We would need capital because see, we are running low on cash. So, but very minimal cash required to reach there. Not more than say 50 crores at the max, 50 to 60 crores.
And how do you plan to fund it? You plan to raise equity or?
We are looking multiple options right now, and we'll come back again. But depends on whichever strategy you want to do. But definitely, we will come back and update you all how you want to do that.
Okay, sir. Thank you very much.
Thank you.
Thank you. Thank you, everyone. You would conclude this meeting. Thank you, Thompson. Do you have any closing comments? So please go ahead.
No, thanks a lot, Asha. That's a fantastic, very interactive session, a learning session as well, a lot of insights as well. Thanks everybody for participating actively in this meeting. Thanks a lot.
Thank you, Sanjay. Thank you, Thompson. Thank you, all participants. Thanks. Bye. Take care.
Thanks everyone. Thanks everyone. Bye.